Imagine a hedge fund so successful that Wall Street called them the smartest people on the planet. A fund run by Nobel Prize winners. A fund that believed it had eliminated risk until it lost $4.6 billion in just a few weeks and nearly collapsed the global financial system. This is the rise and fall of long-term capital management. Long-term capital management was founded in 1994 by John Meriwether, the legendary bond trader from Salomon Brothers. He assembled a team that looked unstoppable, including Robert Merton and Myron Scholes, winners of the Nobel Prize for the Black-Scholes model. Investors couldn't throw money at them fast enough. They raised over $1 billion. Their strategy? Relative value arbitrage, finding tiny mispricings between similar assets and betting they'd converge. Because the spreads were small, the fund used massive leverage to make it worthwhile. These trades only made fractions of a percent, so LTCM borrowed aggressively. At their peak, they held $4.7 billion in equity, $125 billion in borrowed money, and over $1.3 trillion in derivative exposure. Their models assumed markets behaved normally and major shocks were nearly impossible. In reality, LTCM wasn't just playing with fire, they built a rocket engine out of it. In 1998, Russia shocked the world by defaulting on its debt. Markets panicked. Investors ran from anything risky and rushed into safe assets. LTCM had bet these spreads would converge, instead they blew apart. The moves were historic, far beyond what LTCM's models predicted. In weeks, the fund lost $4.6 billion. Margin calls mounted, and the scale of their positions threatened the entire financial system. With markets shaking, the New York Federal Reserve stepped in. They summoned 14 of Wall Street's biggest banks and forced them to organize a $3.6 billion bailout, not to save LTCM, but to prevent a global financial meltdown. The irony? A hedge fund built on the promise of eliminating risk had become one of the biggest risks in the world. So what actually caused LTCM to fail? 4 fatal mistakes. 1. Overconfidence in models. They believed markets behaved normally. They don't. 2. Extreme leverage and 25-to-1 leverage turned tiny losses into catastrophic ones. 3. Crowded trades. Others copied their strategy, leaving no exit. 4. Ignoring liquidity risk, and when panic hit, they couldn't unwind. Long-term capital management is more than a story, it's a warning. No matter how smart you are, the market doesn't care. Models break, liquidity vanishes, and the moment you think risk is gone, that's when it strikes. If you enjoyed this breakdown, subscribe for more 5-minute stories from the world of markets and investing.